Very good evening, members. My name is Siddesh Nagraj Gaddi. I'm a chartered accountant by profession and direct tax committee chairman at Karnataka State Chartered Accountants Association. Members, it gives me immense pleasure to welcome you all to this wonderful webinar. It has been well received by many members in the profession, maybe because it is a short series. It will run into 1 hour plus time dedicated for question and answers. Or maybe because of the topic, we have got a wonderful topic, very controversial, lot of debate around this particular topic. TDS rates applicable for section 195 versus 206 AA versus DTAA rates, 115 capital A, and many other connected provisions. We also have one more topic which is tagged along, that is going to be common issues on Form 15 CACB. I'm definitely sure it is a success. It has been well received because of the speaker. We got speaker of great repute, CA Cotha S Srinivas, who is from Bangalore. Kotha sir, on behalf of Team KSA, I would like to welcome you. Thank you for fixing the occasion and accepting the invite, sir. Sir has always refused to give his introduction to me, and today he has got additional reason because it is short series. He wants us to keep this formalities very short. But nonetheless, from what I know about Kotha Srinivas sir, more than happy to introduce a very brief background of the speaker. Sir has got over 25 plus years of rich experience in direct taxes, in addition to general practice. And in last 2 months alone, sir has conducted more than 10 webinars on this topic, direct taxes. He has also hosted many programs successfully at various branches of SIRC of ICI. I've been a beneficiary. Thank you, sir. And sir is a blessing to this profession. Sir has served over 18 years in this institute, right from Bangalore branch to SIRC. In the very recent year, 2017-18, sir had donned role of chairman of SIRC. Thank you once again, sir, for gracing the occasion. As promised, I have kept pleasantries very short. In under 3 minutes, we have concluded it, sir. With this, we are very eager to hear from you, sir. Over to you.
Thank you. Thank you. Good evening, members. Namaskara ellarigu. First of all, let me thank Karnataka State Chartered Accountants Association, which has given me this opportunity or platform to share a few of my thoughts with all of you. And also thank the Direct Tax Committee of KCA, headed by the chairman, Mr. Siddesh Gaddi, who gave this opportunity, or when he approached us about 195, I said, okay, we can take it up. In fact, in his introduction, he gave a lot of topics, but with so many topics, it's very difficult for anybody to complete it within the allotted time of whatever 60 minutes. But let me try to take you through this topics. Of course, most of you, at least off late, who have completed the CA, it is part of your syllabus, that is international taxation. In fact, when we all did our CA, it was not part of our syllabus. Now it is part of your syllabus and it's part of Income Tax Act. So most of you are aware of these things. Let me try to give my version of section 195, maybe for next 1 hour. Now it is 5:05 up to 6 o'clock. Let me try to cover as much as possible. Coming to the practical difficulties, what Siddesh was telling. In fact, Form 15 CACB, the portal is not ready as of now. Even up to 15th, they said after 15th you can file online. But today is 17th, but still that initial glitches of the technology is going on. So as on today or as of now, still the problem exists. So the problem with respect to online uploading of Form 15 CACB. So we hope that the things will be normal. Maybe in the next week, it will be. We will come to know what is that it has to be done. There are certain changes in the procedure, what we were doing earlier and the present this thing, the new portal. Of course, it's a time that we learn that it's not a very big deal, that it will take a lot of time for us. But the only thing is that particular portal has to start working. So with this opening, this thing, I will start my presentation.
We are able to see the screen.
You are able to see the screen. Okay. So let me start my presentation today. We are talking about section 195 and time permitting form 15C and 15CB. As I said, so what is today? I'll be taking you through the stages of TDS, then general aspects of section 195.
Kotha sir, you are not audible.
Yeah, one second.
Yeah, now it is clear.
Then overview of section 195, the tax rates and form 15CA and CB. Siddesh, at 6 o'clock, can just remind me.
Sure, sir.
Okay. Stages of TDS and comparison with the resident TDS and non-resident TDS. Of course, the stages of TDS is same compared to what we have with domestic TDS. That is the deduction, payment, returns, and certificate. Even under section 195, or when we are making payment to non-residents, the stage of TDS is these four stages. First one is the deduction, payment, returns, and certificate. So the date of deduction, what is the date of deduction in case of non-resident payments, credit or payment, whichever is earlier? As we know, for most of the sections under the resident payments, this is also similar to that credit or payment, whichever is earlier. But there are certain exceptions to this rule where it will be on payment basis, not on credit basis. Then what is the mode of payment? Of course, it's an electronic payment in challenge number 281. Most of, as of now, most of the payments are electronically done. So even for this, that's electronic payment. The due date is 7th of subsequent month for the months where the deduction has been made from April to February, and for the month of March, it is 30th of April. Returns, periodicity and forms, quarterly in form 27Q. So we know that 24Q and 26Q is there, where it will be for resident TDS. Now for non-resident TDS, the periodicity is quarterly returns and the form to be used is 27Q. Due dates, of course, this is also similar to what is applicable for the regular TDS rates, that is dates 31st July, 31st October, 31st January, and 31st of May. So end of quarter, the last quarter, that is January to March, the due date is 30th of April. So the due date for filing the returns will be 31st of May. And finally, the due date for issue of certificate will be 15 days from the due date. That is after 31st of July, 15 days from that particular date. That will be 15th August, 15th November, February, and 15th of June as such. Now, what happens if we don't do this any of this activity or any of these stages? So first one is we have to deduct, but what happens if we don't deduct? First one will be disallowance of expenditure under section 40A1. So under section 40A1, any payment made to a non-resident on which TDS was supposed to be made and not made, that will be disallowed under section 40A1. Apart from that, there is a penalty under section 271C, which extends from 10,000 to 1 lakh rupees, sorry, equal to the amount of TDS that needs to be made. So whenever a person has not deducted the TDS, there are two things. One is disallowance of expenditure under section 40A1, and here the disallowance will be 100% of the expenditure. Then penalty under section 271C is equal to the amount of TDS that needs to be made. Then payment. First thing is deduction, then the second stage is payment. So there may be a situation where a person has deducted the TDS but has not remitted, that has not been paid. So what will be the circumstances or consequences? First, there will be disallowance of expenditure under section 40A1, similar to what it was when it was not deducted. And second thing is it also amounts to prosecution under section 276B. So when any deductor, any person who deducts the TDS but is not remitting to the government, then this prosecution also will be attracted. The next one is he has deducted, but he has not paid within the due date. There is a delayed payment. So when there is delayed payment, there will be interest under section 201. Then the third stage is returns. When once the returns is not filed, what are the consequences? There will be penalty under section 271H, which amounts to 10,000 to 1 lakh rupees. It can be as less as 10,000 rupees, or it can go up to 1 lakh of rupees. Then delay in filing. Apart from not filing the returns, if there is delay in filing, fee under section 234F, that is 200 rupees per day, will be leviable. Then finally, issuance of certificate. If it is not being issued, then penalty under section 270A will be attracted, which is nothing but rupees 100 per day of delay. Now, if we see here, there are four stages as we have understood. First two stages, that is deduction and payment, and the next two stages is returns and certificate. If you see here, deduction and payment is a duty of a deductor which is to be rendered with respect to the government. The next two stages, that is returns and certificate, is the duty on the deductor which is towards the deductive. Why I'm saying this is, say if a person, a deductor, as we know in TDS, there are two persons, one is the deductor and the deductive. If the deductor deducts the TDS amount and makes that payment, then his expenditure will be allowed. But when once he doesn't file the returns and is not issuing certificate, the deductive will not get the TDS credit. So the first two stages is with respect to the government, and the next two stages is with respect to the deductive as such. Now let us see the comparison. Comparison, that is similarities between resident TDS and non-resident TDS. So date of deduction, these are all the similarities what I am talking about. Date of deduction. So it is the credit of payment whichever is earlier in both resident TDS and non-resident TDS, it is same. That is credit of payment whichever is earlier. Then the date for remittance also is same. That is 7th of subsequent month for the deductions made in the month of April to March, or April to February. And for the month of March, whatever the deductions has been done, the deduction date is 30th of April. The date for returns also we understood that is same, similar to resident TDS and non-resident TDS. Date for issuing certificates is also same. Then a nil or lower certificate. Resident can apply, can be applied by the payee under section 197. So any resident TDS, if you are making any TDS to the residents, then they can apply under section 197 to get either nil or lower certificate of deduction. In under non-resident TDS, it's not only under section 197. Also, there is another provision under section 195 subclause subsection 3, where the payee can apply to the department for getting nil or lower certificate. Assessee not in default if payee does certain activity. So now section 201 talks about assessee in default. In case of resident payments, assessee, any person who is supposed to deduct TDS, but he has not deducted TDS, or after deducting TDS, he has not remitted the TDS, then he will be considered as assessee in default. But there may be a situation where if an assessee has not deducted the TDS, assessee has not deducted the TDS, but the deductee on whose income TDS has not been done, he would have considered this particular income and he has paid the relevant taxes and he has filed the return of income. Then the deductor who is supposed to deduct TDS is not considered as assessee in default. So assessee not in default. This particular provisions was applicable only for resident TDS provisions as such, but of late it is applicable to even non-resident TDS. So to explain that, if a deductor has not deducted TDS on a non-resident payments, but a non-resident who has received that particular income, he has considered that particular income, he has paid the relevant taxes and he has filed the return of income, then the person who is supposed to deduct TDS is not considered as assessee in default. The PAN, we know that for under section 216 AA, a resident has to give PAN, or now even Aadhaar can be given. Even in case of non-resident TDS, non-resident has to give PAN. Gross amount, TDS to be done on gross amount, both under the resident TDS and the non-resident payments. the TDS amount has to be done on the gross amount, excluding, of course, the GST and all. Now, what are the differences between the resident TDS and non-resident TDS? TDS rate. In case of resident TDS, the TDS rates are specified in the respective section. To give an example, say if you take 194C, 194J, 194H, they would have given the TDS rates. But when it comes to non-resident TDS, it talks about at rates or rates in force. Of course, one of the section or the main section we discuss is section 195. In 195, they will not give the rate for deduction. It talks about rates or rates in force. Then the limit. Most of the sections, if you see for resident TDS, they have specified the limit. In the respective sections, they say up to this particular limit, there is no TDS. Beyond this limit or after exceeding that limit, TDS will be applicable. But when it comes to non-resident payments, no limit specified and it is taxable from rupee 1. Type of deduction, tax deduction at source and withholding of tax. See, in case of international tax laws, instead of tax deduction at source, they also call this as withholding of taxation. Is there any difference between tax deduction at source and withholding of tax? Basically, there is not much difference between tax deduction at source and withholding of taxation because the characteristics are same. Even here, we are deducting tax and remitting to the government. Even in case of withholding of tax also, we are deducting that tax and remitting to the government. But if you want to draw a line between these two terminologies, that is TDS and WHT, that is withholding of taxes, in case of resident TDS, if you know, we deduct the TDS based on the rate specified in that respective section. Say if I give an example of 194J, if one of our clients is making payments to a chartered accountant being a professional charges, they deduct at the rate of 10% because that has been specified in that particular section as such. But when it comes to non-resident payments, usually what we do or what the resident has to do is he will deduct the entire tax liability of a non-resident. So the differentiation between TDS and withholding taxes under TDS, if I have to say, we deduct a portion of a tax. That may not be a ultimate liability of the particular person, that is the payee. But when it comes to non-resident, we try to withhold entire tax liability. So say suppose if you are making a payment to a non-resident towards a royalty or fees for technical services, you will compare the income tax rate and DTA rate, assume that the rate comes to 10.92% or 10%, whichever is beneficial, you will do it. So when I say non-resident TDS, we withhold his entire tax liability. So that will be the ultimate liability or the final liability of a non-resident. So this is one differentiation we can make between tax deduction at source and withholding of taxes. Surcharge and cess. When we do TDS with respect to resident payments, there is no need to add surcharge and cess. Only specified TDS rate is deductible. So any of the resident TDS sections, if you see, whatever the rate applicable on that particular rate, we do the TDS. But when it comes to non-resident TDS, you have to add surcharge and cess to be added to the withholding of tax. One more thing we have to understand here is, like there is an option to non-residents to take the benefit of double taxation avoidance agreement. So they can either take the rates or rates in force, that is the income tax rates or the DTA rate, whichever is beneficial. So the surcharge and cess has to be applied only when the taxes is deducted under the Income Tax Act, not under the DTA rates. So if the tax is deducted under the Income Tax Act, you may have to increase that by surcharge and cess. But the same is done under the DTA rate. DTA rate is inclusive of surcharge and cess. So there is no need for us to increase that or add surcharge and cess to a DTA rate. So this we have to keep it in mind. Then nil or lower certificate, payer can't apply for the certificate. In case of resident payments, say a resident A is making payment to B, both are residents, A cannot apply. There are A and B where both are residents. A is making payment to B and A is supposed to deduct TDS. A cannot apply for lower deduction of TDS. Only B as a recipient or payee can apply. But under the income tax, in case of non-resident payments, even payer can apply for lower deduction or nil deduction of TDS under section 195(2). Information. So payer need not furnish any other information. In case of resident payments, of course, the 4 stages what I explained, the deduction, payment, return and certificate, that ends the matter. But when it comes to non-resident payments, payer need to furnish information. So this information needs to be furnished in Form 15 CA and Form 15 CB wherever it is applicable. Disallowance, of course, the disallowance under section 40A 1A in case of resident TDS is if it has not been deducted or deducted but not remitted, it will be at 30%. But when it comes to non-resident payments, the deduction will be at 100%. Other legislations, no need to refer other legislation with respect to resident payments. But when it comes to non-resident payments, we need to refer DTAA and FEMA wherever it is applicable or required. So these are some of the comparisons, that is similarities and differences between resident TDS and non-resident TDS. Now we'll move on to understand some of the general aspects of section 195, wherein most of the provisions of section 195 I'll be explaining so that it will be easy when I go to the section 195 as such. Applicability, it applies to non-resident not being a company or to a foreign company. So this section 195 is applicable to non-resident not being a company or to a foreign company. So if you see the residential status, it will be determined as per section 6, where it says in case of companies, all domestic companies are considered as residents and foreign companies are considered as non-resident. But here there is one thing where we have to understand. Section 6 subsection 3 talks about place of effective management. So there is an amendment in section 6 subsection 3 where if a foreign company's place of effective management is situated in India in any time in the previous year, that will be considered as a resident company. So there may be a situation where a foreign company where because of application of POEM, it may become resident company, but still section 195 may be applicable because it talks about non-resident not being a company or to a foreign company. It won't say resident foreign company, non-resident foreign company, because as per the definition of under section 6, all foreign companies are considered as non-resident companies. But because of application of POEM, sometimes this foreign companies also can become resident. At that time, we should be careful whether section 195 should be applicable or regular section should be applicable. As far as my understanding goes, I still feel section 195 should be applicable because it won't talk about non-resident to foreign companies. Then deductible. So on what amount or what is that income that TDS is applicable, or one is on payment of interest and any other sum chargeable under this act. So it says any other sum chargeable under this act. So any interest payment made to a non-resident and any other sum chargeable under this act is subject to TDS. Any other sum chargeable under this act, of course, we may have to refer to section 5, which talks about scope of total income, wherein in case of a non-resident, all income received or deemed to be received in India or accrued or rising in India or deemed to accrue or rise in India is taxable in the hands of non-resident. But any income that accrues or arises or received outside India is not subject to taxation in the hands of a non-resident. After that, we may have to refer section 9, which talks about income deemed to accrue or arise in India. And then we know there are heads of income. If any income is paid to a non-resident, you see whether it falls under any of the heads of income, that is salary, house property, business or profession, capital gains or other sources, and see that it is taxable. If there are certain income which are exempted under the Income Tax Act, then the non-resident, even though he has received that income in India, will not be subject to TDS. So the rates it talks about are rates in force. So as I said earlier, in case of resident TDS sections, all the TDS rates will be given in the respective sections. But in case of section 195, it talks about rates or rates in force. With respect to rates or rates in force, it is defined in section 2, subsection 37, and with respect to section 195, 237, subclause 3, where it says the rates or rates in force means the rate as specified in the Finance Act of a relevant previous year. So in Finance Act, if you see, if you go to Finance Act, in the first schedule, part 2 will give us the TDS rates. So whatever the rate specified in the Finance Act, in every year's Finance Act, or the DTA rate. So you have to consider the Finance Act rates or the DTA rates, whichever is more beneficial to the assessee, that will be considered as the rates or rates in force. And as I said earlier, if you are considering income tax rate, you have to add surcharge and cess, and that needs to be compared with the DTA rate. Whichever is beneficial, you have to take. Just to give an example, say in case of payment made to, say suppose we are making payment towards royalty or fees for technical services. If the non-resident is from USA, let us take an example. The non-resident is in USA. We are supposed to make a technical services payment. So if you see the rates in the Finance Act, the technical services rate is 10%. For that, we may have to add surcharge and cess, as I said. So surcharge is, let us take the highest rate, that is 5%. Then cess is 4%. On 10%, I will add surcharge of 5%. On that whatever the output comes, on that I will add cess. So it comes to 10.92%. But when I go to the DTA rate between India and USA, the technical services fees rate will be 15%. So now I will compare 10.92% and 15%, whichever is beneficial. I will deduct at the rate of 10.92%. Similarly, there is another payment where I'll get a technical service from, say, Singapore. The same thing I will do. The income tax rate will be 10%. I will add surcharge and cess, that is 10% plus 5% surcharge. On that, the output I'm again adding 4% cess. I'll get 10.92%. Then if I compare the DTA rate between India and Singapore, the DTA rate will be 10%. Now I'm comparing 10.92 with 10%, whichever is beneficial, that is 10%, I will deduct TDS at 10%. Now limit, already I have said there are no limits prescribed under this particular section. So TDS starts from ₹1. Payer status. So is it necessary for us to understand the payer status? Yes, maybe the government, whenever the government makes payment to a non-resident, that is subject to TDS. Whenever a resident making payment to a non-resident, that is subject to TDS. And there are certain circumstances where a non-resident is making payment to another non-resident, that also will be subject to TDS. Say in case of 915, if you see section 91, where 915 deals with interest payments, 916 deals with royalty payments, and 917 deals with fees for technical services. There is a situation where a non-resident is making payment to another non-resident towards interest, royalty, or fees for technical services. On certain circumstances, it is taxable. Generally, payments made by non-resident to non-resident is exempted, but on certain circumstances, payment made by non-resident to non-resident is taxable. What is that circumstance? The circumstance is whenever a non-resident is making payment to another non-resident towards either interest, royalty, or fees for technical services, and the person who is making the payment, the non-resident who is making the payment, uses those services or those funds to any business, for setting up any business or running any business or profession in India, then that particular payment will be subject to TDS. Meaning the recipient non-resident who receives from another non-resident for the services which is being used by the payer, that is a one non-resident in the business or profession set up in India, the other persons, other non-residents, for him it will be considered as deemed to accrue or rise in India. So this TDS provisions will be applicable. Payee status, of course, non-resident, this section applies to non-resident. Now when I say this section applies to non-resident, when we have to determine the non-resident status, usually we know the income earned in the previous year is subject to tax in the assessment year. So section 4 says, section 4 subsection 1 says whatever it gives, it's a charging section. It says for every assessee who has earned income in a previous year, they are liable or chargeable to tax in the assessment year. Now, when we talk about arriving at the income or charging a particular person in an assessment year, we arrive at his residential status on 31st of March. So for the previous year, that is now the previous year is 2021, the assessment year is 21-22. If an individual comes to you for filing the return of income for the year 2021, that is 1st of April 22, 31st of March 21. Now this is the assessment year 21-22 where you have to file his return of income. You have to ascertain his residential status for the previous year, that is 2021. That you will ascertain only at the end of the year. But when it comes to section 195, when you are making payment to a particular person, when you have to determine his residential status, should you wait till the end of the year? Say somebody in the month of April, you have to make a payment to a person. So you have to see whether is a resident or non-resident till the end of the year and do the payment or deductions. That's practically it's not possible. So the determination of a status, residential status, whether it's a resident or non-resident, should be done at the time of deduction. Now you need not wait, the deductor need not wait till the end of the year. So there may be situations where a deductor at the time of making a payment to a deductee, deductee may be a resident. Applying the resident sections, he may do the deduction TDS. But at the end of the year, that particular deductee would have become non-resident. So the deductor's liability is not there. There may be another situation where the deductor is making payment to a deductee who is a non-resident at the time of deduction. But subsequently, that particular deductee also may become resident. So you need not bother about that. So the determination of residential status should be done at the time of deduction. Then deduction, we know that on credit to the account of payee or payment, whichever is earlier. But there are few exceptions to this rule. That's what I said. Whenever interest payment is made by the government or public sector banks or public financial institutions, then they have to do only on payment basis, not on credit or payment, whichever is earlier. So public sector banks means all these nationalized banks, whenever they have got these investments from non-residents. So they have got non-resident investments, say fixed deposits and all. Whenever they make the payment, actual payment, at that particular point of time, they have to do TDS. So if it is on accrual basis, if they are crediting the interest, there is no need for deducting TDS. Only on payment basis, they can do the TDS. But this will not apply to cooperative banks and foreign banks. They have to do the TDS on credit basis or payment basis, whichever is earlier. So the basis of deduction, this also I said, TDS is done on gross amount paid or payable. Lower deduction, payee can apply for nil or lower deduction of tax under section 195(3) and 197. So for the resident payments, I said only under there is only one section, that is 197, where a payee can apply for lower or deduction of TDS. When it comes to non-resident payments, the non-resident payee can either apply under section 197 or 195(3). Usually under section 195(3), a payee, that is a non-resident payee, will apply for nil deduction of TDS. Under section 197, he can either apply for nil or lower deduction of TDS. Payer to apply. Payer can apply for nil or lower deduction of tax under section 195(2). So section 195 subsection 2 says, whenever a payer is making a payment, that is a deductor, a resident deductor is making payment to a non-resident, and if he feels that the entire sum is not income in the hands of the non-resident, then they can apply to the department and say, entire sum what I am making payment, that is the gross sum that I am making payment to the non-resident, is not his income. So it's only a portion of that particular sum is income. So on that portion only, I would like to do the TDS. So just to give an example, say there is a sale of property by a non-resident to a resident individual. Let us assume a non-resident has got a property in India and he is selling or transferring that particular property to a resident. When once a resident is buying that particular property, on the sale consideration, he has to do the TDS. So the TDS will be 20% plus surcharge and all, it comes to almost 20.8%. Or if the value is more, then even surcharge may be added for that. So now, we know that in case of capital gains or in case of this particular transactions, the capital gains is subject to taxation, not the sale consideration. So now TDS has to be done on the sale consideration. But in the hands of recipient, that is a non-resident, he can claim the deduction towards expenses incurred and also towards the cost of acquisition and cost of improvement, whatever it is there. But while a resident has to make a payment to non-resident, he has to do TDS on the sale consideration. Now, if a resident feels, the payer feels that the entire sum is not subject to taxation, then he can apply to the department and get for a lower rate of deduction. So this is one example is with respect to capital gains. The other example can be a business income, business transaction where the entire amount will not be income. So when you make a payment to a non-resident towards the say, purchase of goods or something else, purchase of goods TDS is not required or some other business transactions, the entire consideration that we make to the non-resident will not be subject or may not be his income, and the entire thing may not be subject, may not be required to be deducted or subjected to TDS. In those cases, under section 195(2), the payer can apply to the department and say that this is the portion which is the income in the hands of non-resident. On that particular portion, whatever is the rate or whatever is the, if it is a nil TDS or the reduced rate of TDS, we can apply and get the certificate. Now, in the case of capital gains, now there may be a question. Now, in case of capital gains, let us not talk about business income. In case of capital gains, suppose a non-resident says this is my sale consideration and this is my value of acquisition. So, as a chartered accountant, now I know what is the sale consideration. I know what is the expenses that has been incurred. I have a documentation to say that what is the cost of acquisition, and if it is a long-term capital gains, I know I will apply the indexation and also I will calculate. Now I'll get a capital gains. Now, as a chartered accountant, can I issue a certificate stating that this is the only income, on this only I will do the TDS? The answer is no for this, because even though we can arrive at that particular amount, that is, this is the capital gains, on that only I need to do the TDS. We are not supposed to do that. The only option available is we have to apply to the department under section 195(2), under rule 29BA and form 15E. We have to apply that and get the nil deduction or lower rate of deduction, then only we can do. As such, as a chartered accountant, we cannot issue certificates stating that this is the portion of income and this is subject to TDS. We cannot take our own decisions on this. So whenever you come across this situation, my sincere request all of you is to apply to the department and get a lower deduction of TDS and accordingly issue the certificate. So sometimes what happens, even the client will be saying that, sir, everything is on hand, like you have all the details, why don't you issue the certificate? So we cannot issue the certificate and don't issue such certificates. Let us apply to the department and get for a lower deduction of lower rate of deduction, and accordingly we can issue the certificates. Are there any exemptions? Of course, if the salary income is charged under section 192 and not under section 195. So as we have understood, any payment to a non-resident, section 195 is applicable. But if it is in the form of salary paid to a non-resident, then section 195 will not be applicable. It is covered, or it will be dealt with under section 192, like any other salary payments. Person responsible. Who is the person responsible for deducting the TDS? The person includes all types of persons. As per section 2, subsection 31, we have 7 types of persons. All those persons will be responsible for making the TDS payment. When they make payment to a non-resident, they are the person responsible for deducting and remitting to the government. In case of companies, apart from the company, the principal officer of the company is also responsible. And there are certain situations like foreign investment asset is there, where a non-resident has purchased this certain securities by giving this foreign currency. In the foreign currency, you would have purchased certain foreign securities, and when he transfers that foreign securities, and that being a long-term capital asset because you would have held that for more than 12 months or whatever that period is applicable, and it is a long-term capital asset, foreign investment assets. In those cases, the authorized dealers, that is the bankers who are releasing that particular or transferring that income to the non-resident, they will be considered as the person responsible and they have to deduct TDS and remit it to the government as such. Then PE declaration. Of course, whenever we get into transact with non-residents, first thing is we have to ask for whether they have got any permanent establishment in India. So we have to take no PE declaration to be obtained. If they have permanent establishment in India, all these transactions will change. So if they have a permanent establishment in India, then they may not be considered as a non-resident, they will be considered as a residents and other sections will be applicable. Then TRC, we have something called tax residency certificate, or if they are not doing tax residency certificate, we may have to obtain Form 10F from the non-resident. What is this tax residency certificate? So this tax residency certificate gives a thing like even a resident can, like Indians also, we can, being Indians, a resident Indian also can apply for tax residency certificate. The respective income tax department gives a certificate stating that this particular assessee or this particular person is a tax resident of this particular country or territory as such. And section 90 subsection 4 talks about tax residency certificate, and it also says this a person who has a tax residency certificate, a non-resident who gives tax residency certificate will be eligible to enter the DTA or to claim relief under the DTA. So if any non-resident who has to claim relief or benefit under the DTA, the first document you have to ask is to give us the tax residency certificate. Without tax residency certificate, a person cannot enter the DTA, that is double taxation avoidance agreement. So we can say, we can understand that this is the key to enter to DTA. Without TRC, a non-resident cannot take the relief or benefit under DTA. Poem, of course, I said in case of foreign companies, now we may also have to ask whether they have got any place of effective management in India during the previous year. If they have place of effective management in India during the previous year, then that will also amount to having the foreign companies also maybe resident companies. Then non-resident business profit. If non-resident has no P in India, then business profit is not taxable in India. So this I think all of you have. If non-resident and that particular non-resident doesn't have a permanent establishment in India, then that particular business profits is not taxable in India. So whenever we determine the nature of payment as business profits, the next question is we have to ask is whether they have got permanent establishment in India. If they don't have permanent establishment in India and the nature of payment is towards the business profits, then that is not taxable in India. Make available, check for make available clauses in DTA. So this is with respect to some technical services. Technical services and few DTAs, they call it as fees for included services. Whenever we are making payment to a non-resident towards these technical services, we have to find out whether it has got something called make available clause. Make available clause meaning whenever they render certain services. So the make available means they only render the services, but they will not make available technology or how to do that particular service, or in case of particular technology, it will not be considered as a technical service or royalty services. Then it will be considered as business profits, and if they don't have P in India, then that need not be, they need not be subject to TDS. Secondment is assigned to India. So in case of multinational companies, what happens? The people like one particular company, the multinational companies may be having companies across various countries. So in case of a particular project, if they feel that a particular country's employees, they have got expertise, they will deploy that particular persons to another country. So for example, let me take an example by a multinational company in India, and they have got another parent company or subsidiary company or sister concern in USA. There is a particular project in India. They require certain expert people or personnel who are employed in USA. They will be sending those employees to India on secondment, that is called as assignment. So in those cases, depending upon the agreement that is been made between India and USA, what happens, whether this may be a reimbursement of expenses or it may be a technical services. On case to case basis, we may have to see whether payment made by India to USA for getting the employees, that is secondment employees, whether it should be considered as the reimbursement of expenses or it should be considered as technical services, and accordingly the TDS rates will change. Apportionments, whether all apportionments are subject to TDS, the answer is no. It depends upon the nature of payment. If the nature of payment is TDS, even apportion was subject to TDS. The same thing applies to reimbursement. Depends upon the nature of payment. General expenses where there are no upliftment, it is not subject to TDS. Otherwise, whenever the nature of payment, even though it may be reimbursement of expenses, if it is the nature of payment is subject to TDS, we may have to apply TDS for that. Then DTA, of course, as I said, we have to refer the double taxation avoidance agreements before doing the TDS. Withdrawing cash from our own account. TDS is applicable under section 194N if a person withdraws cash from his own account exceeding 1 crore. This is applicable even to a non-resident who withdraws cash in any of the bank accounts in India. Advance payment, if the end payment is subject to TDS, then yes, that is also subject to TDS. Then payment in kind, if some chargeable to tax, then it is subject to TDS. Coming to the rules, some of the important rules 28, 29B, 29BA, AB and section BC. Some of the important forms, form 13. This is a form 13 used to apply for under section 197. 15C and 15B is nil TDS under section 195(3), and 15E is the form which is for obtaining a nil or lower deduction certificate under 195(2). 15CA, CBCC, we know 27Q is the quarterly return. The information that needs to be filed by the deductor in form 15CA part ABCD. Then certification. For local TDS remittances, there is no need for certification. For non-resident payments, it depends upon the nature of payments and the rate of TDS. The certificate should be issued in form 15. Okay. So when a chartered accountant is issuing the form 15CB, what is that is certifying? So the two things that a chartered accountant is certifying is the nature of remittance and rate of TDS. So whenever we issue a form 15CB, these are the two things that we are certifying. What is the nature of remittance and what is the specified list? There is something called remittance under the liberalized remittance scheme, and there are some specified lists where there is no need for form 15CA. Then surcharge and cess already I have discussed. PAN or other section 26A, but there are certain exceptions under rule 37 BBC where PAN need not be provided by a non-resident. The TAN required to deduct tax. So whenever you are supposed to deduct TDS section 195, the deductor has to obtain TAN. Filing of ITR, certain sections exempt non-resident from filing return of income. Foreign exchange. So this is one more practical problem we face. What is the date and rate of conversion? Which is the date on which I have to do the conversion and what is the rate at which I have to do the conversion? Amount payable in foreign currency to be converted as per rule 26 read with rule 115. So if you go into income tax rules where rule 26 and 115, this gives us what is the date on which you have to convert the foreign currency into Indian rupees and also the rate. So the rate given is SBITT buying rate, and dates are given in section rule 26 and rule 115. So what are the punishments? Disallowance, interest, fee, penalty, and prosecution. There is one more penalty under section 271I. So whatever the information that has to be provided by the deductor in form 15 CA, either he has not provided that particular information or he has provided inaccurate information, then there is a penalty of rupees 1 lakh. So for every certificate that we are issuing or every 15 CA that particular deductor is giving as an information, if it is wrong, then he will be liable for penalty of rupees 1 lakh. And this is all some of the practical things revised. Skip these things. Okay, rounding off TDS amount to be rounded off to nearest rupees 10. Then decimal. In returns, tax rates can't be given for more than 2 decimals. So now I said income tax rate is 10.92%. That's okay. If it comes to 10.915% means we cannot find the return of income. That is the statement of returns, that is 27Q. If I have to file the quarterly TDS returns, I cannot put more than 2 decimal points. It will not take. So the tax rate should be restricted to only 2 decimals. If it comes to 3 decimals, you have to round it off to the 2 decimals. Non-filers of income tax return. Section 206 AB recently introduced a section where it applies only to those non-residents. So the 206 AB talks about a specified person. The specified person includes a non-resident who have permanent establishment in India. If a non-resident doesn't have a permanent establishment in India, he is outside the purview of section 206 AB. DSC for form 15CA, it's not compulsory. For form 15CB, it is compulsory. That is a chartered accountant who is issuing form 15CB, DSC is compulsory for him. In case of form 15CA, the deductor, it's not compulsory. If they have, they can use it. Otherwise, even they can do the e-verification. UDIN to be generated and uploaded in IT portal. Of course, as chartered accountant, whenever we issue a form 15CB certificate, we have to generate a UDIN and that has to be uploaded in the IT portal. So there are some more sections which covers this 190, this non-resident payments. Apart from 195, these are the sections which deal with non-resident payments. So these are some of the general aspects of section 195. Now I'll quickly run through this overview of section 195. Section 195 has got 7 subsections. 195 1, 2, 3 to 7. 195 1 talks about scope and conditions for applicability. Then 195 2, 195 3 already we have understood a little bit, where under 195 2 a payer can apply for lower deduction, and under 195 3 a payee can apply for lower deduction. 194 4, 195 4 and 195 or the proceedings. What is the validity of the certificate and who is eligible to apply for under section 195 3. 195 6 is payer shall furnish information, that is in form 15C and 15 CB. 195 subsection 7 talks about assessing officer to determine appropriate portion of some chargeable to tax. Now let us understand this section 195.1, which talks about scope and conditions for applicability. Most of the things already we have understood. Let me take you quickly through this section 195.1. It says any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest not being interest referred to in section 194 LB, LC and LD, or any other sum chargeable under the provision of this act, of course excluding salaries, shall at the time of credit or of such income to the account of the payee or at the time of payment, whichever is earlier, deduct income tax thereon at the rates in force. So this time of deduction we have understood at the time of credit or credit to the account of the payee or payment by any mode, whichever is earlier, and the rate of deduction is at the rates in force. There is no rate given in this particular section, as I said, at the rates in force. Now, if I have to understand this first 1 or 2, 3, 4 lines, it says any person responsible for paying. So any person defined as section 2, subsection 31, all the 7 types of persons, if they are making payment, person responsible for paying, as already understood, It is defined under section 204. 204, section 204 gives us the person responsible for paying. Then to a non-resident not being a company or to a foreign company. How to determine the non-resident, we have to go to section 6, which gives us how to determine a person whether is a resident or non-resident. Then interest. What is the type of payments that we are making to the non-resident is subject to tax under section 185. One is any interest. So any interest payment non-resident is interest paid by an Indian company or certain infrastructure funds or bonds or government securities. Including that, the specified sections are there. All other interest are covered under the provisions. So one thing we should remember whenever we make payment to a non-resident, one thing we have to understand or one thing we should keep it in mind is that particular amount what we make payment to a non-resident should be some chargeable of this act. That is provisions of this act means Income Tax Act 1961. So any type of payment you make to a non-resident, if it is subject to tax under the Income Tax Act, then only section 195 will be applicable. If that is exempted under section 1 under the Income Tax Act, say suppose any payment you are making, say let us take an example, you have a partnership form. The share of income you are making to the resident partner. So share of income is exempt under section 10 subsection 2. But if you are making payment towards remuneration or interest on capital, that is subject to taxation. So if that particular sum, say share of income, is not subject to taxation, then section 195 is not applicable. If remuneration and interest on capital is taxable, then that will be subject to taxation TDS under section 195. So any payment made to a non-resident, first thing we have to understand or we have to see is whether that is chargeable to tax under the Income Tax Act. So for seeing whether it is chargeable under the Income Tax Act, you may have to refer section 4, which is the charging section. Then we will get into section 5, the scope of total income. So as per section 5, the scope of total income, it says whatever income accrued or arising in India or deemed to accrue or arising in India or received or deemed to received in India in the hands of non-resident is subject to taxation. So any of this income, if it is accruing or arising outside India, in the hands of non-resident, it is not subject to taxation. Then when we talk about income deemed to accrue as in India, that has been defined as 9. Under 9, we have to see 9, we have got 8 subsections, 9.1 to 9.8. We have various things where it covers. Say 9.1 talks about business, property income, capital gains, and income from other sources. 9.13 talks about salary income. Then we have dividend, interest, royalty, fees for technical services, and 918 talks about a resident making a gift, a sum of money to a non-resident outside India, that is also considered as income deemed to accrue or arise in India. So we have to see section 4, the charging section, section 5, the scope of total income, and also refer section 9. After putting on the referring all these sections, if whatever the amount that has been paid to a non-resident is some chargeable to tax under the Income Tax Act, then section 195 will be applicable. Otherwise, section 195 will not be applicable. If it is an exempted income, section 195 is not applicable as such. So 204, I said any person responsible for paying, already I have discussed, so I will not spend time on this. So payments made to whom? Residential status of non-resident is determined as per test outlined in section 6. So section 6 gives us how to determine the residential status of each and every person. So in case of individuals and HFs, we have got 2 more classifications. In case of residents, we have resident and ordinary resident, and resident but not ordinary resident, and non-resident. So now there may be a question, resident but not ordinary resident, whether they should be considered as residents or non-resident. The answer is they should be considered as residents. So resident includes both resident and ordinary residents, and resident but not ordinary residents also. And two conditions for attracting Section 195, as I already explained, for payer at the time of payment or credit of income, for payee, some chargeable to tax in India. So in case of payee, only if it is chargeable to tax in India, Section 195 will be applicable. Otherwise, it will not be applicable. So it's if you see the payer is a resident, payee is a resident, applicability of Section 195, it's not applicable. Resident to non-resident, applicable. Non-resident to non-resident, applicable. Non-resident to resident, not applicable. So whenever the payee is a non-resident, if you see, the Section 195 will be applicable. This also I've said, Section 195 applies if some chargeable to tax. You have to refer Section 5 or Section 9. Then also the tax treaty. So the tax treaty is also has to be verified, referred, avoids double taxation, provide relief for taxes paid in other treaty country. This I've already explained, when to deduct actual payment or credit to the account of the payee. There can be three categories of payments to non-residents. One is payments not liable to tax. So this not liable to tax, it can be as per Income Tax Act or as per DTA. So whenever you are making payment to a non-resident, when you see this particular payment, whether it is taxable or exempted, you should first see as per the Income Tax Act. Then if he has got the TRC and if he is eligible to get into this DTA, we have to see DTA also. Sometimes there may be a situation where that sum is chargeable to tax under the Income Tax Act, but it will be exempted under DTA. So there can be, it can be chargeable to tax or exempted for taxation either under the Income Tax Act or DTA. Payments taxable on gross basis. So this is interest, royalty, and fees for technical services, and payments taxable on net basis, which I explained with respect to business income and capital gains. Net income, how to determine? It's also I said we cannot determine on our own. We have to apply for lower deduction and nil deduction with the income tax department. The rates are rates in force 2 subsection 37A subclause 3. Rates are rates of income tax specified in this behalf in the financial year or as per DTA, whichever is beneficial. Then okay. There is one explanation to section 196. In case for non-resident, when income is it is that the non-resident person has a residence or place of business or business connection in India. So there may be situations where a non-resident who is outside India, who doesn't have a residence or place of business or business connection in India, even then, if there are certain services that has been rendered or that certain actions that has taken place, that can be considered as income deemed to accrue or as in India and is subject to TDS. Then 195.2 already I have explained. 195.3 I have explained. So this 195.2 it's an order, and 195.3 is also an order, and the 195C it's a certificate that has been issued. This 195.2 is appealable order. Yes, we can go on an appeal under section 248, but whatever the order you receive under section 195.3 or a certificate received under 197, it is not subject to appeals. 195.4 is a procedural things that I don't want to spend time. Then 195A talks about netting of tax, that is grossing up of tax. So there may be situations where Siddesh, another 5-10 minutes I can take. Siddesh?
Yes, sir. We are exceeding time for good, sir. Good reason. No problem, sir.
It's okay. Another 5-10 minutes.
Yes, sir. Yes, sir.
Okay. Okay. Something concept called grossing up of tax under section 195A. Just a minute. Hello. Yeah. We're talking about grossing up of tax section 195A. Say suppose there may be a situation where the non-resident says, say suppose a non-resident raises an invoice of say $10,000, whatever the dollars, maybe US dollars, Australian dollars, or Singapore dollars, and the non-resident says, I'm not worried about your tax deduction in your country. You pay me $10,000. But assume that there is a TDS of 10% on that. Then we have to make TDS. But the non-resident says, I have to get 10,000 irrespective of your TDS. So I have to get 10,000. Then there's an option where you can gross up that particular amount and pay the balance to the non-resident. So now, if it is in this case, when I said 10% is the TDS, and you have to make payment to non-resident $10,000, then that 10,000 should be considered as 90%. That is rupees minus 10%. The balance payable is 90 to the payee. So if it is 10,000 that you have to make payment to the non-resident, that has to be considered as 90%. Then it has to be grossed up. So it comes to 11,110 it comes. On that 10% comes to 1,110. The balance 10,000 has to be paid. So this is a provision applicable under section 195A. Tax payable at the appropriate rate on the aggregate of the amount paid plus the tax thereon, grossing up can be done. Then 206AA, as I said, for certain provisions, 206AA is not applicable, but still, if PAN is not given, these are the highest of the three rates, that is at the rate or rates in force or at the rate of 20%, whichever is higher has to be applied. 206AB, it applies only when non-resident having permanent establishment in India. Otherwise, this section is not applicable. He will be considered as a specified person if he has not filed the income tax return for last 2 years. If that is applicable, twice the rate or rates in force or at the rate of 5%, whichever is higher. Then 40A1A disallowance already as we have discussed. So these are some of the other provisions. I said there are so many other sections which is covered for non-resident payments, and this is the tax rates. When I can share this particular presentation, you can see this. And then this is the tax rates as per the Income Tax Act, that is the Finance Act. So these are all the tax rates. I have made 3 categories: non-resident individual, other non-residents, and foreign companies. So these are all the rates. This also, when I share with you people, you can go through this. For capital gains, whatever is applicable to resident payments, the same thing applies to non-resident. That is, short-term capital gains 15%, long-term capital gains 10%, and long-term capital gains under section 128 is 10%. Other long-term capital gains 20%. Winnings from lotteries and horse races under section 194B and 194BB, it is 30%. Dividend income is 20%. Interest payable is 20%. Other income in case of non-resident individuals is 30%. In case of foreign companies, it will be 40%. And when it comes to royalty and fees for technical services, the rate is 10%. And any income from investment in case of non-resident individual, it will be 20%. So this, when we are making payment to a non-resident, we have to see this particular rate, and we have to see a DTA rate. So if he has provided you the TRC, we can get into that DTA, that respective type of income or nature of income. We have to see what is the rate, whichever is beneficial, we have to apply. And whenever you apply this income tax rates, as I said, surcharge and cess has to be increased. So that is what I said in income tax rate. If I include surcharge and cess, it comes to 10.92%. Straight DTA rate will come to 10%. 206 AA rate, 206 AA rate 20%. Now, one more thing we should understand in 206 AA rate, that is whenever a non-resident has not provided PAN where he is supposed to provide, and we are calculating the TDS at the higher rate, that is under 206 AA. There, surcharge and cess is not required to be added because it's a penalized rate. And if you see the Finance Act, for 206 AA rates, surcharge and cess need not be added. So that will be the final rate, that is 20%. And wherever the tax rate is at 40%, including surcharge and cess, it comes to 43.68%. So I've just made a table, the various scenarios where you obtained PAN, where you obtained TRC, and whether that particular non-resident has got P in India or not. So wherever that non-resident got P in India, here it is yes and yes, S and S here, so it will be 40% because it's a foreign company. Assuming it's a company, foreign company, 43.68% will come. Wherever they don't have P in India, where they don't have PE in India, then we have to see other things, whether they have obtained the PAN, whether they have got TRC, and based upon what you call this. So this is 10%. So it's a income tax rate or DTA rate at 10%. Here they don't have a TRC, so I cannot take the relief of DTA. I've taken the income tax rate, and here they are not given the PAN. PAN not obtained, so I've taken 20%. Here also there is no PAN, no TRC, and there is no P in India. Still, we are charging at 20%. Then coming to Form 15 CA and CB, Rule 37B talks about that gives us the procedures for filing information in Form 15 CA and CB. So furnishing of information for payments to non-resident is dealt under Rule 37BB. 37BB1, in Form 15 CA, Part A, Part C, and Part D. So for Part A, Part B, and Part D, whenever 15C is applicable, then a charge will be required. We will see that when a Part A, Part B is applicable, there are Rule 3 talks about remittances under liberalized remittance scheme and specified list. There are around 33 list of items that they have specified, and liberalized remittance scheme under FEMA, we know a person can transfer up to 2.5 lakhs US dollars in a particular previous year. For LRS transfers and amount paid under specified list, Form 15CA is also not required. Then 15CA be furnished electronically with DSC and printout to be submitted. 15CA, okay. So Form 15CA, either you can apply, you can submit that with DSC or without DSC. But when it comes to certificate in Form 15CB, it has to be verified using DSC only. So this is section 37BB in nutshell. So now let us come to Part A, Part B, Part C, and Part D. So if you see Part A, B, C, the remittance type is, it is chargeable tax in India. So whatever payment we make to a non-resident, if it is chargeable to tax, either of Part A, Part B, and Part C of 15C will be applicable. So when Part A will be applicable, if remittance during the financial year does not exceed 5 lakhs. So in a particular previous year, if you are making remittance to a non-resident and the total remittance is less than 5 lakh, Part A of 15 is applicable. For that, Form 15CB is not required. Then the second situation where remittance during the previous year or a financial year exceeds 5 lakhs, but they have obtained a certificate under section either of these sections 195(2), 195(3) or 195C, then instead of Part A, Part B will be applicable. Since they have already obtained a certificate for nil or lower deduction, there is no need for CA certificate. Part C is a situation where the amount is chargeable to tax and remittance during the financial year exceeds 5 lakhs and they have not obtained any certificates for lower deduction. The chartered accountant has to certify. So in this case, if you see up to 5 lakhs, there is exemption. Even though it is chargeable to tax, it is exemption, certificate is not required. In second situation, if it exceeds 5 lakhs and if they have obtained certificate under any of these sections, department will say, so this is they will issue a certificate deductor and saying that at this particular rate you do the TDS. Then also there is no need for CA certificate. In this situation C, that is part C, where remittance during the financial year exceeds 5 lakhs and the sum is chargeable to tax, where there is no certificate, then certificate has to be issued by a chartered accountant, which, as I already discussed, we are giving a certificate in which we say the nature of payment and the rate of TDS. So the onus is on the chartered accountant who issues a certificate. So we should be careful while issuing a certificate, determining the nature of payment, the applicable tax rates. Then there is part D, not chargeable to tax. So any sum which is paid to a non-resident but not subject to TDS, it is not, then there is no need for certificates and it has to be given in part D. And usually what happens in the bankers, they insist on form 15 CB for every payment. They will not know whether it is whether it is applicable, that is 15 CB is required or not. Even if there is an exempted payment, or say suppose there is a payment from NRO account to NRE account, it's called as repatriation, or from his Indian account to foreign account. Even for those things, usually the bankers insist for CA certificate, that is in form 15 CB. In all those cases, if the bankers are insisting, even though by law it is not required, you can issue a certificate. But one thing you should keep it in mind, of course, whenever you issue a form 15 CB, you don't forget to generate UDIN, where you have to generate UDIN for every form 15 CB that has been generated. And second thing, what you have to generate is a professional bill. Professional bill for issuing every certificate, you have to raise a professional bill. And the third thing is, after raising the bill, we have to collect the fees also. So these are the things which we have to remember while issuing a form 15 CB certificate. Then there is one relaxation under rule 37 BC. Relaxation from deduction of tax at higher rate under section 206 AA. Any payment made towards this IRTDC, that is interest, royalty, fees for technical services, dividend and transfer of capital assets. In these cases, if even though the non-resident has not provided his PAN, but he has provided the details as per rule 10F, then there is no need for us to calculate the TDS at higher rate. So if they say interest, royalty, technical services, dividend and capital asset, I don't think anything else will be left towards the non-resident payment, because this covers more than 90% of the payments that we make to a non-resident. Then Siddesh, 20, can I close this? Only the steps are there for filing form 15 CA. Siddesh?
Yes, sir. This will be useful, sir. Yes, sir. This will be useful. I request you to please touch upon it, sir. Hope members will be okay. Yeah.
As I said in the beginning, all the participants, still it is not live actually. So this is based on the proposed scheme that I've just taken, but practically when we start using it, we may understand better. So there is steps for filing form 15 CA online mode. Log into the portal, the remitter has to log in. So he has to get into the dashboard where he has to select file income tax forms. There are two selections it seems. One is income tax forms and income tax returns. You have to select income tax forms, then select form 15 CA. Then you can apply, you can select the applicable part A, B and D and fill the details. Then verify the details in the preview page and click on proceed to e-verify and e-verify the submission. So you can do this form 15 CA online. You can set a part A, B, D and you can e-verify. On successful e-verification, transaction and acknowledgement number. Make a note of these numbers for future reference. A confirmation will be sent to the registered email ID and mobile number. So whenever you file form 15 CA online, you will get all these things. Of course, the registered email, entire acknowledgement will come. Even if you want, you can just make note of this transaction ID and acknowledgement number. Then steps for filing form 15 CA. So this I said the form 15 CA we have discussed part A, B and D, where form 15 CB is not required. That is, certificate is not required. When it comes to form 15 CA part C, you have to also do form 15 CB online mode. So form part C of 15 CA and 15 CB. So log into the IT portal of the remitter, get into the dashboard similar to what we did for 15 CA, select form 15CA, select the applicable part, that is part C. Here we have to click on assign CA to allocate the form 15CB to a particular CA from the list of CAs. So when the remitter gets into this particular thing, he should press assign CA. He has to assign a particular CA. When you say assign CA, there may be a lot of CAs, like there may be a person who is doing a statutory audit of a company. There may be a chartered accountant who will be doing the tax audit. There may be a chartered accountant who will be issuing form 15CB. There may be another chartered accountant who will be doing assignment. So there may be a list of chartered accountants in that remitters this thing. He has to assign a CA who is issuing form 15CB, and he has to fill all the relevant information with attachments and click on submit to CA. So there is what you call you can attach certain documents. It says each document should not be more than 5 MB, and the total documentation should not be more than 50 MB. So whenever remitter enters these details, he can attach certain documents. The documents can be even, he can give the invoice raised by the non-resident, or he can give a no PE declaration, he can give a TRC. So whatever he can attach and send it to the chartered accountant. Then log in to IT portal CA. So after this, the chartered accountant who is issuing the certificate has to log into his portal. Then in the dashboard, work list, pending actions, for your action, you have to go. Then from the list, select the form 15CB and click on accept. So when the deductor says assign a CA, the chartered accountant should go and accept that particular thing. Then a success message will appear. Again, you go back to the work list. From the list, select the form 15CB and click on file form. So you should go back to after this particular, you have accepted this form 15CA. Then again, you go back to the work list and go to form 15CB. Then click on file form and you fill all those details. Select the mode as online and click on continue. Details filled by the deductee will appear in 4 categories. So whatever the details that has been filled by the deductee will be appearing in 4 categories. It may be the remitter details, remittee details, remittance details, and tax details. So the chartered accountant can review or modify the details and click on verify. So if he feels that whatever the information that has been provided by the deductor is proper, then it's okay. Otherwise, he can modify, alter those details, and he can put all these details. Click on preview and proceed to e-verify. Subsequently, the chartered accountant can e-verify that particular submission. Here, I feel that using DSC is compulsory. In 15CA, when the deductor is making a submission, DSC may not be required, but when it comes to a chartered accountant, compulsorily DSC has to be attached. And here also on successful e-verification, you can just make note of transaction ID and acknowledgement number. Once the CA has filed the form 15, so first there are 3 stages. First, the deductor will enter into the portal, his portal. He will assign a CA and fill up certain details and leave it. Then the chartered accountant will enter into his portal and verify whatever the details that has been filled by the deductor. And if he wants to make certain modifications, he will do, and he will approve that, and he will do the e-verification. Then last step is once the CA has filed the form 15CB, log into IT portal, that the deductor. So the person who is making the payment, he will do that. Then go to dashboard work list for your action. Select accept or reject. So either here, the deductor can either accept or reject form 15CB uploaded by the CA. So if he feels that he doesn't want that, he can reject that. For reject, provide the reason. For accept, enter the remaining details in form 15CA. Verify the details in the preview page and click on proceed to e-verify. E-verify the submission using DSC. So first the deductor, the person who is making the payment, he will enter into his portal, do all those details, then assign a CA. The chartered accountant will get into his portal. He will verify everything and upload the form 15CB. Finally, again, the deductor will get into the portal. He will verify this form 15CB, and if he wants to put some more information in form 15CA, he will do it and e-verify. In between, he can even reject form 15CB. If he feels that it is not required or it is not proper, he can reject Form 15CB, and of course, again, he has to start from the first process. So there is something called offline mode also. The department has recently released offline utility for filing various statutory forms. So this, I think, we can go through. And what are the common fields in Form 15C and 15CB? Name and address of the remitter is to be given. Name and address of the beneficiary of the remittance, and contact information, residential status of the remitter, PAN if available, details of remittance, details of TDS, verification of the form. So actually Form 15C and 15CB has not changed. So whatever the Form 15CB was there earlier, it has not changed. Only the procedures have changed, or the portal has changed. So Form 15CB don't have any changes. So those of you who are already using Form 15CA and 15CB, the same form is existing. Only the portal has changed and certain procedures have changed. So with this, I think I've come to the end of this presentation. Try to hurriedly complete it. Still have exceeded time. Once again, thank you for KCA and the Direct Tax Committee of KCA for giving this opportunity to share a few of my thoughts with each and every participant. Thank you once again.
Thank you, sir. So thank you for gracing the occasion. We should have had it for about 3 hours instead of 1 hour, sir.
Fact,
Anyway, we'll call you once again, sir.
In fact, next week in Coimbatore, we are having for 3 hours.
Oh, yes, sir.
No.
In fact, we'll definitely call you once again, sir. There is a lot to learn from your presence. If time permits, sir, if you're willing, I'll take just 2-3 questions, sir.
Yeah.
With your permission, sir.
Yeah, we can take.
Yes, sir. So there is a sale of shares by one non-resident to another non-resident, which is liable to tax under Section 195. But because it is done at cost, the querist is asking whether there are multiple questions, sir. Should buyer still withhold taxes, even though, as per Supreme Court decision in the case of Transmission Corporation and GE India, there is no TDS. That's the question, sir.
No, from one non-resident to another non-resident, if it is transferred outside India, there are certain transactions under Section 47, which is not considered as transfer. So maybe you may have to first go through that. There are certain transactions, like it may be certain bonds or global depositor receipts, or certain shares transferred from IFSC units and all. It is not considered as transfer. First, we should explore that. And second thing, as I said, even if it is a Transmission Corporation India case, that's where it came under Section 195(2) I was talking about, where the entire sum is not subject to taxation. Then we may have to apply the department get a nil or lower deduction of TDS. So here, if you say even if you are transacting at cost, the TDS is applicable on gross sum. And if you feel that there is no sum chargeable to tax, or entire sum is not subject to taxation, then we may have to apply to the department. Accordingly, we have to do the TDS.
Sir, the follow-on question on this very same facts, whether 15 CACB should be complied with, because transaction is happening outside India is the question.
15 CACB law is different and practice is different, because the bankers, they have got a checklist. They say whether you have 15 CA, you have 15 CB, you have the Innovas, you have A2 payments. So they have some checklist. Without that, they will not clear the amount. That is any foreign remittance, they will not do. The bankers will not understand whether this is taxable, not taxable, whether part A, part B, part D. Even though maybe by this time they may be knowing about part D, where we say it is not chargeable to tax, but still they insist. And as I said earlier, whenever they insist, kindly issue, generate UDIN, and also generate the professional bill and collect the fees.
Sure, sir. Thank you, sir. Sir, whether Form 10F is equal to TRC?
No, Form 10F is not equal to TRC. 10F contains information. So 90 subsection 4 talks about TRC, 90 subsection 5 talks about some other information relating to TRC. So why 10F we will take is sometimes this TRC will not be in English. So every country will not issue this particular TRC in the English language itself. So they may issue in their own language. Say like from Germany, it may come in German language. When it comes from Spanish, it may come in Spanish language, or from Dubai, it may come in Urdu, where we will not be in a position to understand clearly what the TRC says. At that particular point of time, we will get 10F to get more clarity on that. So it's not a substitute as such, but yeah.
Thank you, sir. By taking the benefit of MFN, most favored nation, can we claim make available clause?
Yeah, you can.
That's the question, sir.
There is a MFN more favored nation clause is there, and where it is applicable to some, it is referring to some other DTA where this make available clause is there. Definitely, we can take that benefit.
Sure, sir. Thank you, sir. So next question, in the absence of PAN as well as TRC, can we just obtain Form 10F and go about with claim of DTAA benefits?
That's what I said. TRC, it says clearly, it says TRC has to be there to enter the DA. Just give me a minute, I will see. For 95 also, keep.
Yes, sir.
It's always better to insist on TRC. Not under 10, you will not go into this thing.
Sure, sir. Sir, there are many feedbacks which we have received, sir. I'll read it in the meantime. Feedback, sir. Okay. Excellent presentation. Very kind feedbacks which you got it in the chat box. I'm sure even you will be able to see it, sir.
Yeah.
PPT will be shared with the sir's permission. We'll put it on KSA website. There are questions on availability of YouTube recording, which will also be there on KSA's official channel on YouTube.
One more question is there. A Swedish company incorporated in Sweden is always tax resident as per local laws. Do we need to insist for TRC for DTA benefit? Yes, you have to insist on TRC. Because an Indian company is also an TRC is only we are getting a tax residency certificate. So it's always better to get it.
Sure, sir. One very simple question, sir. Does DTAA and TDS applicable only to company?
What is that?
And not individuals.
DTAA
and TDS applicable only to company and firms and not to individuals.
It applies to everybody.
Yes, sir. One last question, sir. We'll take it and because it's clarify the difference between withholding taxes and TDS was enlightening. That's this one. Little lost, sir. It's a very small window. So one last technical question, and we can close it with this. 15 CB has been successfully sent to taxpayer. For the deductor to accept 15 CB in his portal under work, further under pending list, the page has been loading for a day, but deductor is unable to accept 15 CB. Technical doubt. The new website.
It's to contact somebody in Infosys and get it clarified.
Yes, sir.
Of course, it's a problem, I should say. Whenever that new software comes, we may have to bear with that. But how much to bear is a question. Because they said, department said 1 week. In the first week of June, we kept quiet. But now it is taking more than a half. So they have to quickly see that it has to be corrected, and we will start working on that. About it, all the practitioners.
Yes. Sure. So two very interesting questions, sir, but very short in nature. So I'll take it with your permission. What is our liability if the Form 15 CAA is challenged by tax authorities?
See, the ultimate liability is on the deductor. The ultimate liability is on the deductor. But as I said, what is the certificate that we are certifying? I cannot run away from the saying that I don't know anything. I just have given a certificate. So some liability definitely there, because we are determining in the certificate or we are certifying the nature of payment and the TDS rate. So we should be more careful, and you should have that this thing before issuing the certificate. And yeah.
Yes, sir.
So
One last
better
question is, what
always
is the
when
norm when it
professional
comes to charging
liability-
fees?
Yeah.
Sorry, sir.
Tell me.
Sorry, sir. Please continue.
No. Always, because when once we are doing all these things, of course, there are a lot of changes that happens in the law. There are a lot of case laws. So always we should be careful, and we should also, I should say, invest more time on this. And at the same time, my sincere advice is you have to charge reasonably well. It's not that just for some certificate you charge very less amount. If it is one-off certificate, at least minimum you should charge 5,000 rupees and above, not less than that. If it is a continuously, if you are doing
Yes,
that is month on month, you are getting some certificates, you can have some negotiation, but not too less. So that is also one thing we are do it, because you have the income tax act, you have to refer the agreements, or you have to refer the DTAs and any relevant case laws. All those things has to be done. So it's always advisable to charge reasonably well. And whenever you are having certificates continuously, say suppose you get a client issue, they say that every month we will have these type of transactions and we need certificates. My advice is first time in assignment to do in-depth and prepare an opinion, to get some opinion. The bigger you can do that, so continuously you can start issuing the certificates for the entire year. So we should analyze and understand what is the nature of payment, whether it is taxable, not taxable. If it is taxable, what is the rate of TDS and all. So that one exercise, it's always suggested to do it. So have some backup papers, so that will be helpful for us.
Sure, sir. Thank you, sir. With this, I think we can conclude the session. I would like to acknowledge presence of Vice President of CA Chandan Hegde, sir. Cotha S Srinivas, sir, thank you once again. There is a lot to learn from you. We'll keep inviting you to CAC forum.
Chandan Hegde has come.
In spite of
Chandan Hegde is
the
on.
schedule, you have graced. Yes, sir.
Yeah. Namaste, Hegde sir.
Namaste.
Namaste.
Thank you very much, sir.
Thank you once again, sir. Despite your busy schedule, you have made it to the forum.
Thanks for the
Really appreciate your time, sir.
Thanks.
Thank you, sir.